Imagine you're winning 6 out of every 10 trades. You're nailing the technical analysis, spotting trends a mile away, and yet your account balance is still slowly bleeding to zero. Many retail traders operate under a severe misconception. They fall into a perfectionist trap, assuming that surviving in the markets requires an accuracy rate of 70 or 80%. This assumption leads them to default to a simple 1-to-1 risk-reward ratio. On paper, risking $50 to make $50 looks perfectly reasonable. It feels exactly like a fair coin flip. But forcing yourself to maintain a high win rate to tread water is a high-pressure trap. In the volatility of real markets, relying on a 1-to-1 ratio is a statistical death sentence. To survive in Forex, you have to abandon the exhausting pursuit of accuracy and adopt a totally different mathematical formula: expectancy. That fair coin flip we just mentioned, it doesn't actually exist. Invisible transaction costs, known as market friction, secretly sabotage a 1-to-1 trade before it even begins. This equation shows a 10-pip target against a 10-pip stop loss. Instantly, the goal distance is squeezed by a 2-pip spread and slippage, shrinking the functional target. Thus, a 1-to-1 strategy demands a win rate above 55% just to break even. This is exactly why professionals utilize a 1-to-2 risk-reward ratio. It is a strict minimum baseline that neutralizes market friction right out of the gate. Simulating 10 trades at a 1-to-2 ratio, you hit 6 red losses and 4 green wins. Despite failing mostly, your equity line trends solidly upward. Your mathematical break-even point drops to 33%. A realistic 40% win rate secures long-term wealth. Adopting a minimum 1-to-2 ratio gives you the room to be wrong most of the time while still remaining profitable. However, you can't just type a 1-to-2 ratio into your platform and expect free money. It has to pass a reachability test. This chart shows a typical setup, but the 2x target line extends directly behind a thick, major daily resistance level. The market is highly unlikely to cross a major structural barrier just to satisfy your ratio, making this an invalid setup. You also have to measure against volatility constraints, like the average true range. If a pair averages an 80-pip daily move, but your target is 150 pips away, you are banking on a massive outlier. Your required mathematical reward must logically align with the chart's path of least resistance. Forcing a 1-to-2 ratio into a structural zone where the market has no logical reason to go is a gamble, regardless of the math. We also have to account for our own biology. Traders naturally suffer from the disposition effect, the dangerous emotional urge to cut winning trades early out of fear, while stubbornly hugging losing trades in the hope they reverse. Utilizing a strict 1-to-2 rule with hard set and forget targets bypasses this completely. It removes all mid-trade emotional negotiation and forces the math to play out. Losing streaks are inevitable. The dividing line between an amateur and a professional is measured entirely by the speed of their drawdown recovery. Let's compare the math of recovery. If you take a 5-trade losing streak at a 1-to-1 ratio, you need 5 consecutive wins just to claw back to zero. On the 1-to-2 side, it takes only 2.5 wins to reach the top. The 1-to-2 ratio functions as an automated behavioral guardrail and an engine for faster recovery. Forex trading is a game of probability, not certainty. The 1-to-2 ratio serves as your mandatory buffer against human error and unpredictable market noise. Audit your last 20 trades. Look at exactly how your historical equity curve would have changed if you had strictly held those setups for a 2x return. You have to strip away the ego associated with being right and trade for the objective reality of being profitable. You can map your new operational baseline right now by downloading the FXNX risk-reward audit spreadsheet and running your own math. True survival requires executing a mathematically sound strategy on a platform designed to minimize friction, utilizing environments that offer 0.0 pip spreads.